Anthony Grasso here, bringing you financial news that you can use. In this series of videos, I'm going to go look at stocks to possibly invest in to recession-proof your portfolio. In this particular video, I'm going to do a stock analysis on Grainger. Now, is Grainger worth investing right now with that big jump up in the stock price over the past 2 months? There's definitely mixed feelings about this stock, so let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, analyst projections, and give up my personal buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell if you'd like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. And as always, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so Grainger distributes maintenance, repair, and operating products and services in the United States, Japan, Canada, United Kingdom, and internationally. The company operates through two segments, the high-touch solutions and the endless assortment. Now, it offers safety and security supplies, material handling and storage equipment, pumps and plumbing equipment, cleaning and maintenance supplies, and metalworking and hand tools. It also offers inventory management and technical support services. The company serves businesses, corporations, government entities, and other institutions through sales and service representatives and electronic and e-commerce channels. Now, Grainger was founded in 1927 and is headquartered in Lake Forest, Illinois. So let's go ahead and look at the recent news of the company right now. Well, 2 weeks ago, the second quarter results came out for Grainger, and I'm going to include the highlights for you right here. So they delivered sales of $3.8 billion. That's up 19.6% compared to the second quarter of 2021, up 22% on a daily constant currency basis. It expanded gross margin by 255 basis points compared to the second quarter of 2021. It generated operating earnings of $534 million, up 60%, resulting in earnings per share of $7.19, an increase of 68% versus the second quarter of 2021. It returned $219 million to shareholders through dividends and share repurchases. It published a 11th Environmental, Social, and Governance report highlighting Grainger's focus on driving sustainable supply chain operations and furthering diversity, equity, and inclusion. Now, the increase is full year 2022 guidance, including updated total company daily sales growth of 14.5 to 16.5%, driving earnings per share range of $27.25 to $28.75. All right, well, that's really great news for this industrial partner. Now, let's look at some of the fundamentals of the company. So the current trading price of Grainger right now is $578.44 a share, with a market capitalization of around $29.4 billion. Now, the company is projected to have about $15.06 billion of revenue for 2022, with earnings of $1.42 billion. Now, the revenues are projected to increase over the next few years to around $16.54 billion by the end of 2024, with the earnings increase to $1.6 billion. Now, the forecasted earnings growth are around 7.2% per year, and they're forecasted to grow, but not significantly. Now, let's look at some valuation analysis, the key measures of the company. Now, because Grainger is in the trading companies and distributors industry and has positive earnings, the price to earnings ratio and the price to book ratios are the most appropriate valuation measures. The price to sales ratio is less instructive than the price to earnings since the company has positive earnings. Therefore, Grainger seems highly valued right now with a PE ratio of 22.12 times. That's one of the highest in the trading companies and distributors industry. Now, when you look at share price versus fair value, the fair price of Grainger when looking at its future cash flows, for this estimate, we're going to use the discounted cash flow model. Grainger is expensive based on the price to earnings ratio compared to the estimated fair price to earnings ratio of 21.7. So it's overvalued. Let's look at the profitability of the company. Now, Grainger is one of the more profitable companies in the industry, with a net margin of 9.78%. Its net margin is among the strongest of any peer, while its operating margin and gross margin are above the medians. Now, looking at the dividends, they definitely have a dividend, and they pay an annual dividend of $6.88 a share, which at a current stock price is a current yield of 1.22%. This is below both the industry average and the S&P 500 average at 2.44% and 1.95% respectively. However, most other companies in this industry do not even pay a dividend, so that's definitely a plus for Grainger. Now, the dividends per share have been stable and increasing over the past 10 years. Now, looking at the potential growth of Grainger, now the earnings growth has outperformed revenue growth over the trailing 12 months. Now, this is a trend that is not sustainable if profits are to continue at this rate. However, this result has been better than that of the average company in the industry, where earnings fell over the period. And finally, looking at the financial strength of the company, the total debt to capital ratio of 48%, which is in line with the industry's norm, with an interest coverage of 24.27 times and a quick ratio of 1.44 times, the company should be able to comfortably repay its debt. So the big question is, what do the analysts say right now on Grainger? Now, the analysts are completely mixed right now. As you can see here, the average price target of Grainger in the next 12 months is only $542 a share, with a high estimate of $642 and a low estimate of $422. So let's just take that for a moment, to take this in for a moment. The current stock price is $578 a share, and they're only saying the average target price over the next 12 months is $542. That's definitely important to remember. Now let's go over some of the analyst reports that we have brought up over here. Now the Street Quant Ratings recommendation, they rate Grainger as a buy right now. Now this is driven from several positive factors, which they believe will have greater impact than any of the weaknesses, and should give investors a better performance opportunity than most stocks that they cover. Now, they say the company's strengths can be seen in multiple areas, such as robust revenue growth, solid stock price performance, impressive record of earnings per share growth, expanding profit margins, and compelling growth in net income. They feel that its strengths outweigh the fact that the company has had generally high debt management risk by most measures that they evaluated. All right, so and then we also look at the Ford Equity Research Report. They also have a buy recommendation on Grainger. Now, that's a result of their systematic analysis of the three basic characteristics that they look at. They look at earnings strength, relative valuation, and recent stock price movement. Now, the company has managed to produce a neutral trend in earnings per share over the past 5 quarters. However, while recent estimates for the company has been mixed, Grainger has posted better than expected results. Now, based on operating earnings yields, the company is about fairly valued when compared to all the other companies that they cover. Now, here's the kicker with this report from Ford Equity Research. They say, quote, share price changes over the past year indicates that Grainger will perform poorly in the near term. So remember that. All right, so let's go on to, and I'll discuss that in a few minutes. So let's go on to the last report I'm just going to briefly discuss, the Cfra Report. They have a buy recommendation upgraded from a hold on Grainger shares reflects their positive view that the company is well positioned to gain market share in the current operating environment, given several competitive advantages, including efficient inventory management, a global supplier network, and established reputation within the industry. The company has been able to raise prices on its products to maintain a favorable price to cost spread, particularly in its high-touch solution segment, where it can leverage its stronger customer relationships. Despite broader macro uncertainties, Grainger continues to see a robust demand and positive sentiment from its customers. Let me bring it back over here. So based on all this information right now that we've been thrown at, am I a buy, hold, or sell recommendation on Grainger right now? Well, here are my thoughts. Now, the recent stock rise can be attributed to overall bullish sentiment that raced through the market last month. but the primary catalyst was the enthusiasm investors exhibited in response to the company's second quarter 2022 earnings report that I just showed you. Now, besides looking at the previous quarter's performance, management addressed the 2022 guidance in its earnings report, raising it from the initial forecast, whereas Grainger had originally expected to book sales of approximately $14.7 billion. It now projects 2022 sales to be about $15.1 billion. Similarly, management updated earnings per share guidance as well, raising it to about $28 from $26 a share. Now, Grainger raised this forecast for the company's cash flow as well. Initially, management projected operating cash flow of $1.25 billion. Now, however, it foresees generating $1.3 billion in cash from operations. So a little bit more. Now, there are a lot of investors out there, like myself, are worried about an economic downturn, but Grainger doesn't seem so concerned. They do have a backlog. Now, they appear optimistic that the coming months will be the ones for growth for the company. And it's not as if that growth is attributable to any one industry that Grainger serves. Management forecasts sales growth from customers in a variety of industries, including transportation, natural resources, healthcare, and retail, just to name a few. Now, Grainger may be a stock to consider as a conservative approach to fortifying your portfolio. However, though, the analysts are conflicted with this stock. Some saying sell, others saying hold, and a few that I just showed you are saying buy. Now, the ones that are saying buy right now, they state this as their thesis. We strongly believe that the industrial economy will decouple from the consumer economy and go higher, even if the consumer economy dips down. Now, while the strength in the industrial economy isn't new, its ability to power through a downturn in consumer spending is a change from past cycles. Now, the company does have a solid track record with excellent balance sheet and does pay a dividend. So based on all of this information, I am currently a sell recommendation on Grainger with a 12-month price target of only $550 a share. So let me explain here for a minute. I would wait this one out until the stock makes a dip and target a buy in price of around $500 a share. I would buy and hold for the long-term growth and dividend payouts. For me right now at $577 a share, there's only a little upside potential and a definitely more downside risk for the near term. Remember that report I just showed you? They project that the share price will be bad in the near term. The stock is already up 22% in the past month alone. Now, this historical performance should lead to below average price performance in the next 1 to 3 months. That's my prediction. Now, a sharp slowdown in industrial activity or risk. Let's go over some of the risk to this. If there's a sharp slowdown in the industrial activity, but the industry experts say the manufacturing economy is sizzling hot right now. There could be more intense price competition for Grainger. There could be weaker than expected or delayed federal government spending, further deterioration of supply chain issues causing products to be backlogged even further, and negative foreign currency impacts. So basically, I'm keeping this one on my radar and seeing if it dips to about $500, and then I would buy it and hold for the long term. This would be a long-term play, because if you buy right now and it dips down to 500, you just lost your shirt right now. But that's just my opinion. What are your thoughts? Do you think they're just going to barrel on through? Or if you look at the recent price history of the past year, it does have its ups and downs and has been on a bullish trend over the past 2 months. It's due for a slight correction, and I say that slight correction would be down to 500. But leave your comment down below. I definitely would like to hear your what you think. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing. Hit that notification bell if you like your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.